I can only hope.
Kind of hungry.
Yeah, you're always hungry.
All that and more coming up over the next 2 hours right here on Bloomberg Business Week. First up, though, a check of the day's trade and top business stories. Here's Charlie Pellett.
Hi, thank you very much indeed. From the burgers and beans to the bulls and the bears, with the Dow, the S&P, NASDAQ, all moving higher right now. A lot of green on the screen. Going to begin, however, with the Russell 2000 index of small cap shares. It is surging today by just about 1.9%, outperforming the S&P up by 0.2%. S&P higher by 9. 59.79 was flirting once again with 6,000. We have got the Dow up 387, up 0.9%. The NASDAQ Composite Index up 18, up by about 0.1%. Your 10-year at 4.26%. The 2-year 4.27%. A retreat for gold down 3.4%, 26.23 the ounce. West Texas Intermediate crude down 3.1%, 69.06 a barrel. Bitcoin right now at 94,761, down 2.3%. As for the overall market backdrop, Nicole Inouye is head of U.S. and LATAM equities at HSBC.
I will definitely say I think valuation is the big pushback, and it's difficult. You look at the S&P, 20% of the companies are trading at a PE of above 30 times. So this is the highest level we've seen even during the dot-com bubble back in 2000. So, and this is across sectors. So, of course, tech is a big part of it, but you're seeing some consumer staples, you're seeing some financials trading at very high PEs.
Nicole Inouye of HSBC. Briefly, Tesla's EVs would be excluded from consumer rebates being proposed by California's governor, a decision aimed at spurring greater competition that's likely to draw the ire of Elon Musk. Tesla shares today, they are trading lower by 2.1%. Recapping, S&P up 11 right now, up 0.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellett. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Do appreciate it. Well, after underestimating the stock market strength over the past 2 years, Wall Street strategists are back to their bullish ways. They're walking a well-trodden path when it comes to their predictions for where the S&P 500 index will go in 2025. We're talking about year-end targets from firms including Goldman Sachs, Morgan Stanley, BMO Capital Markets, and more. We got with us Alexandra Semenova, Bloomberg News Equities reporter. She joins us here in the Bloomberg Interactive Brokers studio. Alex, before we get to next year's number, I want to kind of leave everybody, anticipating what these strategists are going to say. If we go back a year ago, you weren't in our studio exactly a year ago, but you were here around that time.
Time flies.
Time flies. The S&P 500 was at about under 4,600 then. It's up more than 31% since then.
Really, really unbelievable.
Nobody got it right.
No one got it right. Strategists anticipated roughly the same closing level going into the year. And of course, we're on track right now to have the biggest gap from their expectations to where the S&P 500 actually closes.
Well done, team. Well done, team.
Rude, Carol Master.
Well, listen, we talk about this all the time, right? The strategists set their targets. I know it's sometimes hard to call, and there was a lot of twists and turns again in 2024. Go back a year and what the expectations were about Fed rate cuts, right? And here we are again. So wait a minute. For someone who this is your job or part of your job, tell us about how you're thinking about the new round of targets that are being set, and how are we supposed to kind of read anything into them?
Well, it's a hearty annual ritual on Wall Street, from small firms to big banks. It's something that you kind of can't escape. It's almost a necessary evil of the job, where you know that there is no correlation between what stocks actually do and these predictions oftentimes. But at the same time, you have to give your clients some sense of where you think the market will go. And usually it's a good way to look at it directionally rather than putting too much emphasis on exactly how much, the expectation is for a gain or a loss. And in this case, it's actually quite interesting. Strategists are playing it quite safe when they're coming out their targets. They all fall around the 6,500 to 6,600 line. That's about an 11% gain from Friday's closing level.
They all are kind of around there?
They kind of are clustered around there, which is, pretty predictable given the fact that the annualized return on the S&P 500 is 11%. So strategists are playing it safe. They're expecting a gain, but that is a contrast from the past 2 years when they thought the market would go nowhere, and obviously we're massively wrong on that.
It's so funny. Here we are back from Schwab Impact. We were out San Francisco, and so we talked to Lizanne Saunders, we talked to Jeffrey Kleintap, we talked to Kevin Gordon. Really, fun deep dive into what they were thinking. And what was struck me with Lizanne and Kevin is they said, listen, there's a lot of stuff we just don't know yet in terms of policies from the new administration, that it's going to take some time for that stuff to kind of work its way through before we necessarily can kind of, with conviction, start to think about where we go from here.
Absolutely, and that's kind of something that it feels like a lot of people are neglecting. There's so much excitement around getting a clear outcome from the election, about rate cuts, but at the same time, we don't know what the next administration will do. And we also have 2 consecutive years of returns of more than 20% on the S&P 500. That has only happened 3 times in the past 100 years. So the chances of us getting any big gains next year are actually statistically smaller because of that reason.
Makes me nervous.
It is a little bit nerve-wracking, and also if you look at the history of bull markets for the past 50 years, the third year tends to be a little bit quieter than previous years, where the expectation is for single-digit returns. More stocks are expected to fall if you look at history.
And we're overbought. Like you look at like something like the S&P 500, but we've been overbought before, only to pull back and then just rally again.
Right, we're trading already at 22 times earnings, I believe, right now, and so there's not much more room for the rally to go.
Where are the bears?
Apparently nowhere. We
hard
had
to be a bear.
obviously Mike Wilson, who was, established his reputation for being a bear, is now predicting a 10% gain going into the new year. So he's kind of
maybe
abandoned
stocks are
that.
gonna go down.
Marco Kolanovic, no longer at JP Morgan Chase. There's not many contrarians anymore on Wall Street, which tends to be something to be nervous
But you
about.
follow him closely. You broke that story earlier this year. Is he quiet right now?
He's been kind of quiet. I think he's just doing his own thing. We'll see what's next for him.
But no predictions, no year-end targets?
He's been tweeting here and there, and it seems like his view hasn't really changed, that he thinks that the market is a little bit frothy, it's a little bit overbought, and people are overexcited about AI. People are underestimating geopolitical risk and the risk of policy uncertainty.
Did anyone did they all wait until the election to come out with their targets?
It feels like it, yes.
Did their
Most of them
targets
started to go.
mention policies?
They do mention policy in the election, but not at this point as something to be highly concerned about. The expectation is that perhaps we'll get some more volatility next year. We won't have that breakneck pace of gains, but for the most part, the economy is still supposed to do well. Earnings are still supposed to grow. So as long as that is the trajectory, then we're expected to see more
Alexandra,
upside.
what matters more? It being a presidential cycle, first year of a new president or one returning versus, that we're in the third year of a bull market? Like, I'm just curious what really matters.
I think if you ask anyone on Wall Street, the most important thing of all is company earnings, right? As long as they're delivering on those financial readouts, then rate cuts, what a presidential cycle aren't necessarily as important as companies being able to deliver on their earnings expectations.
It was also interesting at Schwab Impact, right? We were talking with Lizanne and Kevin Gordon and Lizanne Saunders about the importance of immigration for companies.
People brought this up over and over again.
Right? Like, that struck me, that of the things that they were really kind of top of mind, of just companies having access to workers.
Exactly.
If they don't, that means higher costs for them, and that's going to impact their balance sheet.
Well, several folks we talked to talked about the economic shock of deporting millions of people from this country and what that would actually do to payrolls and to the labor force. And I think because of that, some people are wondering whether the president-elect would actually go through with this plan.
Right?
Yeah.
Like logistically and cost-wise and so on.
Absolutely. If you look at all these potential policies, tariffs, the deportation of workers, they're all supposed to be really inflationary, which obviously could pressure the stock rally. But at the same time, a lot of people think that Trump is someone who cares a lot about what Wall Street thinks. He's really inclined to be liked by the Wall Street elite. And so he's going to be watching the market to make sure that he doesn't employ any policies that will put a dent in this equity rally.
This is what you do, the ins and outs, on a daily basis of what's going on in the U.S. financial markets. I am curious, since the election, as you talk to people, I don't know, are there narratives that are, being created? Like, what's the tone that you are hearing?
The tone right now seems to be that a year-end rally looks very likely. I mean, seasonally, it is on the side of equities that, they tend to do well into the end of the year.
We made it through another year.
But 2025 feels a little bit murkier because bond yields are back on the rise. That is something that could put a lid on these gains that we've seen.
What did all these strategists get wrong last year? What was it specifically? Yes, the targets were wrong, but why were they wrong?
It seems like people once again underestimated how much big tech can actually run. We actually had Piper Sandler's Michael Kantrowitz, who by the way recently won Institutional Investors Top Strategist Award. He actually dropped setting S&P 500 targets. He said when big tech comprises such a big share of the index, it's much harder to predict, and that has been a lot of things, a lot of what people have flagged as what they couldn't predict.
I'm just going to say some of the top performing names in the S&P 500, Vistra Corporation up more than 300%. I don't know who they are. Palantir up 274, NVIDIA, okay. But GE Vernova, Axon Enterprise, United Airlines, Constellation Energy, Fair Isaac. These are not your big mega cap tech companies, right?
Yeah.
But the problem is they're not responsible for the movement of the index because they're not weighted like those other companies.
I understand, but it's interesting to see that, in terms of the broadening out of the market, which is something that folks have talked about, that maybe that's a good sign.
Yeah, and that, is also part of the expectation for next year, that broadening will be a theme. Barclays had a little bit of an interesting point this morning, though. They said that people are overestimating the expectations for earnings for the S&P 493, and they think that big tech will once again continue to dominate. And if there's been any lesson from the past 2 years, then maybe it's worth following that advice.
That equal weighted S&P 500 is only up 17% so far this year.
Still pretty, not bad.
It's not bad.
Pretty.
That's not bad.
Oh, it's only in the sense of compared to the S&P 500.
Right, still
Yeah,
underperforming.
right? Like
More than 20.
Mag 7, I think it was more than 50%, which is double the S&P 500's performance. Pretty incredible.
All right, good stuff. Nice perspective. Thank you so much.
guys.
Alexandra Semenova, she's equities reporter at Bloomberg News, joining us right here in our studio. I'm looking at the markets, folks. We've got about 40 minutes to go until the closing bell on this Monday. S&P 500 just up about 12 points, so call it pretty much unchanged here. Same thing for the NASDAQ 100. It is unchanged, just up by 2. So the Dow's the outperformer here.
Next week, we're talking bonuses, or next week.
No, we are? Wait, I didn't get that memo.
Next segment, we're talking bonuses in investment banking. That's right after this.
It's 3:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ 100 index, Russell 2000 all higher. Little change right now, as a matter of fact, on the NASDAQ 100 index. The Russell 2000, though, up 1.9%. S&P higher by 11, a gain there of 0.2%. The Dow up 395, up 0.9%. NASDAQ up 25, a gain there of 0.1%. And to be clear, we've got the NASDAQ 100 index swinging between gains and losses. 10-year at 4.26% with a 2-year yield 4.27%. Spot gold down $89 the ounce, a drop today of 3.3%. West Texas Intermediate crude down 3%, 69.08 a barrel, and Bitcoin down 2.3%, 94,811 per token on Bitcoin. Macy's says it is delaying its third-quarter earnings release after an investigation revealed an employee hid more than $100 million of expenses. Emily Cohen is following the story for Bloomberg News.
So we are wondering a lot of things. First of all, how did Macy's miss this? I think it's going back to 2021. So that's many years, many quarterly reports where this money presumably wasn't accounted for. How was it missed? Also, where did all the money go? We don't know where that money went at this point.
Bloomberg's Emily Cohen interviewed this morning on Bloomberg Television. Macy's shares, they're down today by 3.2%. So again, recapping, U.S. stocks higher, S&P up 11, a gain of 0.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thanks so much for that update, Charlie Pellet. A Bloomberg scoop today, also a most read story. Our colleague Todd Gillespie reporting that Citi is using retention bonuses alongside management changes and tech upgrades to remake the bank's offering for ultra-rich customers.
Interesting.
Yeah.
So doing more, doing less?
Trying to keep these employees on by enticing them. And also the new or new-ish head of wealth management has been doing a lot of traveling to many parts of the world to meet with clients.
I got to say, the wealth business, right? That's something that I feel like whoever we talked to came up with the folks over at Schwab on the West Coast. I mean, right? It's the wealth management business just continues to grow. If you didn't notice, we are approaching bonus season. Meredith Dennis has a great view on how that could look for Wall Street. She is managing partner at the financial search firm Prospect Rock Partners. The company does placement in finance, also operations for private equity firms, investment banks, and the like. She joins us right here in our Bloomberg Interactive Broker studio. Welcome, welcome. How are you?
I'm doing great. Thank you.
Well, tell us about your world and what you are seeing in terms of placement, demand, who's hiring, what kind of hiring, what's going on?
So there's a lot going on, and a lot has happened since the presidential election. I think we're seeing definitely an uptick in hiring over the past 2 weeks. We're seeing firms really start to close on their pipeline, and as they get the deals across the finish line, there's more certainty in terms of fee income. More certainty in terms of fee income means more money for the bonus pool, and also more money for deepening that bench.
So Meredith, was this just a case of deals waiting for the election outcome? Or like, help me understand, because deals actually are in the pipeline, they're working. And so I don't know if there's really a cause and effect here. Tell me.
Well, I think there was a couple of things that happened. Number one, I think the interest rate market started to stabilize. I think given the rate cuts, along with the certainty from the presidential election, deals really started to move across the finish line. I think prior and even second quarter, there was a lot of discussion of pipeline, but a lot of those deals just didn't close. A lot of hung deals, and that caused a lot of uncertainty in terms of hiring and also what could potentially impact bonuses. Now we're seeing deals come across the finish line.
Yeah.
Fee income is coming in, so bonuses are much more certain than they had been.
Bonuses for who, though?
Bonuses, I would say for debt capital markets, I would say that would be up 20%, 20 to 25%. You're seeing the equity capital markets open up again. M&A, you're seeing deals come across the finish line there, and so I would expect, a 5 to 10% bump in bonus for them. We're not talking 2021 levels, but definitely a much rosier picture than it has been over the past 18 to 24 months.
Your team shared with us some notes. So the most significant compensation rebound since the record-breaking 2021, is that fair?
Yes, that is.
Interesting. Okay. So do you expect it to continue? Does 2025 even look more promising?
Well, I think 2025, if you consider the fact that the pipelines are really robust, and there's a genuine feeling of momentum, and the interest rate environment is stabilized, and we now are moved past some of the presidential uncertainty. So yes, I do think 2025 is going to be a lot rosier, given the certainty of the markets.
Carol and I talk a lot about the first Milken Institute Global Conference that we went to post-pandemic was, help me out, Carol, October of 2021. I
think
believe.
So, yeah.
And then we went to another one a few months later because that's when the
spring one,
the
which
spring
is
when
normally.
they're normally doing it. Private credit has been just the talk of that conference the entire time. I see you nodding your head, Meredith. What are you seeing in your world when it comes to private credit
Explosive.
right now? Still.
Explosive.
Still.
Absolutely. I think private credit is much more nimble, obviously, than the public debt markets. And I think, it's become kind of the sweetheart of private equity in a lot of ways. And so I think you're going to see continued explosive growth in private credit.
Even if rates go down?
I think it will take a while for rates to go down, and the flexibility of private credit is extremely attractive. And the innovation behind it, it's really a creative debt product.
So when it comes to jobs and people looking for jobs, is a lot of it private credit? Like what is going on that you're seeing, right? You're involved in placement.
Right.
I'm just curious.
So there's private credit is really hot right now, but investment banking is starting to really pick up. Before, in the last 18 months, I was seeing a lot on biotech, biopharma, life sciences, M&A. I'm seeing a lot, obviously, I was seeing a lot in terms of software, fintech, investment banking. Now we're seeing it expand to FIG. You're seeing some consumer, some industrials. So it's really kind of an exciting time. It used to just, yeah.
Well, do you do placement for roles that are in technology too?
On the corporate side, corporate development. So not on the, more on the strategic M&A side than on technologies.
The reason I ask is Carol did this panel last week at the Schwab Impact Conference about
AI.
All about AI.
Yeah.
And one question that you said kept coming up was, when are these banks going to, well, some of them are doing it. Schwab is doing it. JP Morgan is doing it. But do their own versions of these chatbots, these LLMs. And I'm wondering the hiring that's happening around there.
That's interesting. I imagine as they come out, the hiring needs will increase. I haven't seen it, but that doesn't mean it's not there and happening. It just means maybe I'm not privy to that side of the market right now.
Hey, I am curious too, within your world, like how closely people are watching President-elect Donald Trump as we are obsessed with the nominees, and as he's really kind of very quickly laid out what his administration could potentially look like if everybody gets confirmed and if it all settles in. But how closely, in terms of some of the things you're laying out, is contingent on kind of who is in those top spots, whether it's SEC, whether it's the various financial regulatory bodies. We've been bodies, I should say. We've been talking a lot about Scott Bessent, right, for Treasury Secretary, and the market seemed to like that. Help me out here in terms of what you are hearing on that front.
I think a lot of it has to do with the regulatory environment and how stringent the regulatory environment is going to be going forward. And so anybody, the market likes anybody who is a little bit less stringent. And so I believe that this, I think what we're seeing in terms of nominees are people that are going to be relatively hands-off.
Yeah.
And the market likes that.
Yeah.
And so that, I'm not saying that, it's a wave on through for every merger deal, but definitely maybe a little bit easier than it has been in the past, or even just with the certainty of who it's going to be, is giving some solace to what's going on in terms of M&A.
Right.
So are you hearing a sigh of relief from your clients right now, or this sense that, hey, we're going to be able to do a lot more over the next 4 years than we were able to do?
So I am hearing a lot of, we right-sized, the market. The recruiting market was kind of a little sluggish, obviously, as banks right-size their employee base. And now I'm hearing, hey, maybe we should deepen that bench. It's time to kind of build the reserves back a little bit, because it will be busy. So I don't know if it's a sigh of relief or just a genuine feeling of optimism that things are going to be busy.
So, yeah, in terms of mood and sentiment, I mean, I feel like you have a really good vantage point, right, in terms of the people that you talk with, probably small firms, big firms, lots of different firms across the different types of, financial firms, as we said, investment banking, or whether you're dealing with PE or private credit. So is there been like a noticeable shift in kind of mood post-election? And is it just, the election's over? Is it something more than that?
I think it's more than that. What I'm seeing is that the bulge bracket is coming back into the market. As the bulge bracket comes back in and the elite boutiques start to pick up a little bit more aggressively than just opportunistic hires, the middle market starts to shake in their boots a little, because that's where those opportunistic hires and aggressive hires come from. Those middle market employees who have really solid closed deal experience, maybe A to A promotes. And so all of it is just pushing upward a little bit. So this is one of the first times that we're seeing people really up tier in brand. I haven't
So
really
people
seen
moving
that.
from like a middle market firm up to
or like a tier 2 to a tier 1. That's happening a little bit more. All the RIFs that happen, they've kind of been cycled through. A lot of those people who were really qualified people have found jobs, which is wonderful news. So if you think you're going to be picking up, somebody from a bulge bracket elite boutique who's been riffed due to kind of a sluggish environment, that's not going to happen anymore.
Geographically, where are the hires happening?
New York, San Francisco, Chicago. I would say Chicago is really interesting because of industrials. You'll see in the interest rate environment, going down means that industrial business will go up. Charlotte, and probably energy, a little bit of Houston, renewables.
You didn't say Miami.
Love Miami. Love Palm Beach. A lot of healthcare down there. A lot of healthcare hiring down there.
Okay, no offense, but RIF versus layoff. I don't know that reduction in, what is it? Reduction in force? Is that what it means?
Reduction in force. So, I think reduction in force is typically kind of a larger group of people, and it could have been a firm-wide performance, or it could have been a market impact or something like that. Whereas,
I've never have you?
No.
Very cool stuff. Very cool stuff. Great perspective. Thank you. Thanks for coming in. Meredith Dennis. She is managing partner at Prospect Rock Partners right here on Bloomberg.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ, all very much in the green. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks are higher, but well off their best levels, with the Dow still up 408 points. S&Ps are up 12, while NASDAQ pairs gains to up 0.2%. The U.S. 10-year falls to 4.27%. Gold is sinking by 3.3%. Oil is under pressure, and Bitcoin, that's off by 2.3%. Among the main 11 S&P sectors, leaders were consumer discretionary and real estate. Tech and energy were in the red, and leaders to the upside in the Dow, Sherwin-Williams and Caterpillar, while NVIDIA fell 3.6% and led to the downside. In the EV space, a new California EV credit would exclude Tesla. And in the retail space, Macy's delayed earnings after Worker hid more than $100 million of expenses. Cassava Sciences plunged 84% after its Alzheimer's drug trial failed to meet its goals. And wrapping things up, Agilent and Zoom Video report after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill Maloney, and to hear live breaking news over your Bloomberg type squawk, SQUA, on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about 18 minutes left in today's trading session, getting ready to wrap up the Monday trade. A shortened holiday schedule this week because of Thanksgiving, Horace, and it does feel like it's a little bit mellow.
It's going to be quiet.
Yes.
On Wednesday, I imagine.
I would say so. Yeah.
Friday
Might be
at the
all
New
good.
York Stock Exchange is a fun day because everyone brings their kids in.
Oh, do they?
Yeah, Santa shows up. It's like a holiday tradition. It's pretty cool because the kids are off of school, but the traders have to do a half day.
And there's plenty of room on the floor because there's no traders on the floor anymore.
That is so true.
Just gonna say.
That is so true.
Let's see what our next guest has to say about the market environment. Jim Schmigel is Chief Investment Officer at SEI. They've got about $1.6 trillion in assets under management based in suburban Philly, joining us right here in our Bloomberg Interactive Brokers studio in New York City. Hello, welcome. How are you?
I'm doing well. Thanks for having me.
Great to have you here. 1.6 trillion, that's a lot. A lot of institutional investors?
A lot of institutional, a lot of retail. There's a lot of AUA in there as well as AUM. So
Yeah,
we are
good
a
point.
bit of a diversified financial services firm. We do three legs of our stool. We do back office outsourcing, particularly in the alternative space.
Yeah.
We have a technology platform which does really, really well with banks, large banks, money center banks, regional banks. And then we have our asset management platform as well, which is not surprisingly where I find myself housed nowadays. So in an OCIO context, we're dealing with institutional investors, DB, DC, ENF, but on the retail side as well. So delivering model portfolios, to registered investment advisors, to regional banks, things along those lines.
All right, so what's changed since the election for you?
Well, what's changed? I guess first and foremost, we're risk on. We're feeling really good about that. Our investors are feeling really good about that.
So what does that mean? Did you guys start moving stuff more aggressively into certain areas as a result, or not yet?
Well, I wouldn't say we've been moving anything post-election. As a fiduciary providing advice, you have to look past the election. And of course, that's what we did. We looked at the commonalities between all the potential outcomes. It was pretty obvious early on that the tails were kind of being taken out of the distribution, particularly from like a Democratic sweep perspective. So that was one that was pretty unlikely, just given the numbers, particularly in the Senate, were really kind of stacked against the Democrats. So we knew that there were some outcomes that were very, very unlikely, focusing on those that were more likely, that there was going to be divided government. Typically, markets love divided government, keeps government kind of all, kind of busy with itself and kind of not focused on everything else.
This isn't really divided government.
Well,
though.
that's the outcome that obviously came to bear, is not that at all. But the market is pretty happy about it. So
does it make you nervous that policies will happen maybe too quickly without the checks and balances that we've had in the past?
I don't think so, because it's not, within the House, within the Senate, you're looking at fairly slim majorities. And, the cabinet that is being put together, particularly Friday's news with Bissant, I mean, pretty favorable result from that kind of debate over who's going to be the next Treasury Secretary.
What does that signal to you about whether Trump makes good on the tariff promises that he made during the campaign, and also on other economic promises, including reducing the workforce here in the U.S. by deporting a lot of people?
Yeah, I think it adds, and you're seeing it today. I mean, with the 10-year trading below 4.3%, 4.27 before I walked in here, that's a big, big move. So, what the market is assuming is that, some of the things that Scott has articulated before about the Trump policy, really putting it into the context of, look, this is an opening salvo. You're talking about a big real estate investor here who's used to negotiating. The market likes that message. So in this idea that we're taking kind of some of the tails out of the distribution, what the market feels like to me today, the tail that's being taken out is 60% on China and 10% on everything else. That's kind of off the table, and it's going to be a little bit more strategic. Probably not going to be as big as what most people think. Probably will be phased in, and therefore that kind of knee-jerk kind of view that this is going to be this huge inflationary impulse that we're going to see in 2025, I think a lot of investors are reassessing that.
How much do you think about history? We were talking with our Alexandra Semenova earlier because the Wall Street strategists are putting out, their targets for the S&P 500. FYI, didn't do so well last year.
Yeah. Everybody got it wrong. No recession last year. That was the big goal. Big flop.
Come on, guys.
So we're in the third year of a bull market, right? It's pretty phenomenal, the returns that we've seen. Very bullish gains this year, last year. The third year historically, at least over the past 50 years, has historically been the weakest, with single-digit average gains and a much larger percentage of stocks suffering declines. This is some data from BMO. I don't know. What do you think will really be the catalyst for the market? Will it be historically? We've had 2 big years, so maybe it's time for a down year. Yeah. Will it be a new president who, yes, he's been in the White House before, but who knows what we might get this time around? Will it be ultimately the U.S. economy and earnings? What is it?
I think it's rates. I think that's what everyone should be kind of focused on. We have a robust economy. We're going to get a first view of GDP later on this week. We'll get PCE. But look, the reality is we're close to 3% on GDP. We're still above 3% on inflation. And the Fed's in easing mode.
So we don't need those cuts?
I don't think we need these cuts. Now, a lot of cuts have already been priced out, right? So the Fed put themselves in a little bit of a bind. When they came out of the gate with 50, totally unnecessary. I think they're locked in for December. I think it would be odd from an optical perspective to come out with a 50 basis point cut, do a 25 after the election, and then pause. So we'll probably get another 25 basis point reduction in December and then start talking about skipping meetings and pausing in early December. But the reality is we're lowering rates. We're stimulating an already fairly robust economy. We're going to get less regulation for sure. We're going to get tariffs in some way, shape, or form, hopefully not as big as what everyone expected. That's the thought. That's what we're trading off today. But that doesn't tell me 4.25 on the 10-year. That tells me 4.75 on the 10-year, and that's what we're looking at.
We know what the Federal Reserve tells us, and we know what Jerome Powell tells us during press conferences, but do you buy that they aren't making decisions based on potential policies?
They're human. It's a very, very tough job. I hate to be the critic out there kind of throwing stones. It's very, very hard to kind of look through. I mean, think back to where we were prior to that September meeting. People calling for emergency rate cuts. I mean, crazy. The data can turn so quickly, which in our mind, or in my mind, I should say, I mean, that almost begs to go slow. That's what they should be doing. The 50 was something that just did catch me a bit off guard. It was the last one before an election. You don't want to appear political in any way, shape, or form. Do they have it in the back of their minds now? What might be on the horizon given the red sweep? How can they not? I mean, they're unfortunately, like all of us in this business. I mean, they're designed to predict the future.
Well, look,
that's a horrible.
And Carol, they also look at the bond market, and the bond market is making its own reactions. So
Absolutely,
it is. And it's very well behaved today. So and this is the volume's going to be down this week. We're going to see some kind of big moves. So you're going to have to look past this week, obviously.
Wait till we all start talking about that fiscal deficit. Dealing with that.
Well, that's a great thing to talk about because one of the things that I would always say to investors is that doesn't matter who wins, deficits are going higher. Hey, I don't know. We're talking about it. It's in the conversation now.
Jim, thank you so much. Really appreciate it. You're listening to Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenbeck on Bloomberg Radio and Television.
All right, I just grossed Tim out for a second time. I am still getting over my cold. I'm doing cough drops, but I have to kick him out.
No.
When we're talking, and so I have
TMI.
a little cup of water. This is the sausage being made inside our studio. I'm really sorry. I don't mean to gross you out.
Do you hear what's going on over at Starbucks?
Look at Tim. He's like,
I'm looking for Charlie Pellet.
I'm done with you.
I'm looking for Charlie Pellet because Charlie goes to Starbucks every day.
He's like, just stop.
Charlie goes to Starbucks every day.
Well, you know, he's really funny when he talks about the names and stuff.
Yeah, I
Like
know.
he kind of mucks around with people.
Where
is he?
We'll get Charlie in here.
Bueller?
He's not in here.
All right, what do we got?
So Starbucks said a ransomware attack at a third-party software supplier has disrupted its system for tracking employee payments, forcing them to manually track workers' scheduling and hours.
What?
Charlie, did you notice this when you were at Starbucks earlier today?
Yeah.
Ironically, I'm trying to break up with Starbucks, but it's impossible to do.
You are?
It.
What did they do
for
to you?
About 4 years.
What did they do to you?
No, the problem is they're too convenient. Their reward program works for me, but there's independent coffee shops that I try to go to, and I wind up going to Starbucks all the time.
All right, we'll find some third wave coffee shops.
Stenbeck or Master Coffee, I'm in. But
so there's a cyber attack, apparently a ransomware attack happening at a third-party software provider. It's a Panasonic subsidiary called Blue Yonder Group. It provides supply chain management. They said their systems were disrupted by a November 21st ransomware incident. Starbucks is among the customers and used Blue Yonder software to schedule shifts and track retail workers' hours in North America, a company spokesperson said.
Not the pen and paper.
Well, if you think about this from a scheduling perspective,
I can't even imagine. I don't know.
This takes us back to...
Although people used to do it that way.
But look, this is another story, Carol, where when you rely on a third party in order to, which we all do, all companies do. Look what happened to Delta earlier this year.
Right, and that was pretty serious.
Just takes you offline completely.
Yeah, a representative for the UK grocery chain Morrisons told Bloomberg News on Monday that the Blue Yonder breach had impacted warehouse management systems, but added that the stores are now operating satisfactorily on backup systems.
Welcome to the store, Brian Nickel.
So UK grocery stores were also dealing with this same problem?
It's like I mean, this is what happens when you have the same software.
I don't know about you, but I think about this constantly. You know, we surveyed you guys. I don't know how much you all think about this, but, we are so everything's digital, right? Everything is like there and it works. And I just think, is there just a moment where we're going to have like some kind of mother lode where systems are taken down? We've seen certainly pockets of it, right? Some serious ones.
Stuff.
But it really is a
Electrical
little...
grids. What happens to traffic safety signals?
Everything works this way, right?
This is that's like the horror story scenario here. That's like what happens in movies, right?
Yeah,
the
exactly.
Power plant gets taken offline.
Yeah. So this attack apparently did impact also some UK grocery
What happens
store
to
chains.
Homer Simpson running the nukes?
Yeah, don't go there.
Okay.
That could get ugly. No, but I do think about that. I always, go back to Jamie Dimon years ago and the things that he was worried about, technology and cybersecurity and, right, like just thinking about increasingly the role of technology in everything and anything we do. And you just wonder when a system goes down. Yes, sometimes it's, maybe you're not getting scheduled right or you're not getting the right coffee, but sometimes it's a lot more serious, potentially.
All right, we're going to take Charlie to some other coffee shops.
We are? Where are we going?
I don't know. He said he's trying to, diversify the offering a little bit.
There's coffee upstairs.
I know. I should tell him.
Coffee, Zippo.
I think we'll tell him.
Yeah.
We'll tell him.
Like,
hey, a couple other headlines. I'm going to be talking about crypto in just a second. A little tease.
Where do you want to go?
The Trump crypto project gets a $30 million investment from Justin's son. This is pretty amazing.
Tell me about it.
The controversial China-born crypto entrepreneur Justin Sun, he's invested $30 million in President-elect Donald Trump's World Liberty Financial, making him the largest investor in the decentralized finance project.
SEC suing Sun back in March of 2023 for allegedly violating securities rules.
Okay, but here's what actually is
Just
fun
sharing.
to talk about. You might recognize his name for a few reasons.
What's
A
that?
couple days ago, he announced that he paid $6.2 million for that banana duct taped to a wall, part of a piece of work by the Italian artist
My
Maurizio
favorite
Catalano.
moments were listening to Tom Keene talk about it. I think
They taped it an orange up to the...
I love that. I love art. I didn't get it. What do you do with that? I
Hey.
don't know. You know what we do? Right now we're heading over to our TV colleagues because we got to talk about this market close, the closing bell starting now.
The The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Steele, taking you through the closing bell, a global simulcast. It starts right now. Scarlett Fu joining us in the TV studio, Carol Massar and Tim Stenovic in the radio booth as we welcome our audiences across all of our Bloomberg platforms here on this Monday afternoon. Big outperformance today, Carol, by the small and mid-cap stocks versus the large.
Yeah, interesting. I got to say, though, I've been looking at the Treasury curve and just seeing yields back down again. Some optimism over the nominee for U.S. Treasury Secretary. Just reminds me how sensitive this market is going to be with all the twists and turns potentially of the upcoming administration.
You guys are watching stocks and treasuries. I'm still waiting for Bitcoin to hit 100,000. So close.
So close.
You have balloons ready? You ready to go?
No.
Hats and everything.
If you had a balloon, you'd have to keep changing the number on the balloon. That's the problem.
Within $300 of hitting $100,000 just a few days ago,
you know,
down to 95,000.
Yeah, well, I mean, give it a few minutes and it could all change, right? My question about the bond market, kind of celebrating Scott Bessent's nomination, is that he was chosen in part because of his commitment to tariffs, which is seen as inflationary. So it's a little bit of a head-scratcher, and I talked to Priya Misra of JP Morgan earlier, and she said what the bond market is really focused on is his commitment to tackle the deficit and to tackle deficit spending.
Or this could just all be positioning headed into a shortened holiday trading week and towards the end of the year as well. That U.S. exceptionalism theme, though, clearly continuing throughout all areas of the market.
Yeah, we talk about another day higher for the market, and more importantly, another day where we see the large caps taking the back seat to the smaller and more cyclical parts of this market. That's the broadening that a lot of folks wanted to see, and at least for right now, they get it. Scott Rubner over at Goldman Sachs saying this is the start of a year-end rally. 1% higher today on the Dow Jones Industrial Average, 0.3% higher on the S&P 500, 3% higher on the NASDAQ Composite, 1.5% higher on the Russell 2000. S&P mid-caps up 1.5%, and Carol, Dow Transport's going to close out the day higher by 2.2%.
All right, good to know. S&P 500 overall, remain breaking down those big numbers. You had most names in the S&P 500 higher, 386 to the upside, Scarlett, 115 to the downside, 2 unchanged.
Yeah, that's reflected in the sector breakdown as well. You've got REITs, consumer discretionary, and materials all up about 1% or more. The weak links in today's market, the biggest sector in the S&P 500, tech losing about 1/3 of 1%, and energy down about 2% on the day.
All right. Can I just point out, too, before you go, just going back to a conversation Alex and I were having on TV, at least 105 S&P names today hit 52-week highs.
Interesting. All right. Well, here's a name that definitely popped up.
That's 20% of the index, Carol.
Hey, some mansplaining on the percentage. I really appreciate that.
That's journalist math.
Love it.
All right. Here's the number one gainer in the S&P 500, the NASDAQ 100, guys. Super Microcomputer up another 16% in today's session. It was up 80% in the last week. That was the largest weekly gain on record. But we know since the company has submitted that plan to remain listed on the NASDAQ, naming a new auditor, they have definitely had a lot of upside momentum. But keep in mind, still off about 70% from a record that they set back in March. All right, off to another gainer, up 6%. What? Are you good?
Yeah.
Okay.
Keep going.
All right. Thank you very much. Yeah. Moderna up about 6%. This was an outperformer in the NASDAQ 100. Remember on Friday, company management said RFK's nomination to the Department of Health and Human Services unlikely to mean that you'll see the removal of vaccines. They said this at a Jefferies fireside chat. Stock has rallied 22% in the past 3 days, still down more than 50% year to date. 10% of the float shorted.
But was there an actual fire?
What?
Yeah.
What do you mean?
I don't know.
What are you talking about?
Nothing.
All right.
I love it when Carol forgets to ignore me.
I know. It's like, all right, company's going to be presenting at a bunch of healthcare conferences in December. All right, I got one more. I'm going to try and get through it. AMC Entertainment. Did anybody go to the movies this weekend?
No.
No, Wicked and Gladiator. Did you see one?
Wicked. I did neither. AMC Entertainment, though, I was pretty happy to see people back at the theaters, and so you saw popping that one up about 7%. Tim's getting ready to take his kids, though, to some movies. Are you thinking about it, right?
Moana 2, man. Come on, right?
That's going to happen.
Yeah,
that's a birthday party. That's a
ticket.
drop-off birthday party. We're excited about that one. Hey, Tesla shares falling today by 4%. Look at that. This is interesting. After Bloomberg News reported that Governor Gavin Newsom of California, he unveiled plans to offer state incentives to EV buyers if President-elect Donald Trump repeals that federal subsidy after he takes office next year, and he said Teslas would be excluded from such rebates. The idea is that this would spur greater competition. So the governor's office told Bloomberg News that the proposal includes market share limitations, and those limitations would exclude Tesla from those credit shares. We're pretty steady during the day, but then fell late in the session, finished down 4%. Macy's shares fell 2.2% today. This after the company said it would delay its third quarter earnings release after an investigation revealed an employee hid more than $100 million of expenses. We do expect Macy's to come out with those numbers by December 11th. We'll wait and see if they release more information about this employee, quote, intentionally making erroneous accounting accrual entries tied to $132 to $154 million of cumulative delivery expenses stretching over multiple years. The company said this earlier today. Once again, shares down a little more than 2%. And look at this one. Cassava Sciences fell 84% today. It's the largest decline on a record for the company since it went public back in the year 2000. The company said its Alzheimer's treatment did not show a significant reduction in cognitive or functional decline versus placebo in patients with mild to moderate levels of the disease. This is in a phase 3 study. Investors selling as a result today.
All right, I just want to touch on yields, guys, because this was pretty exciting in the space. You got buying across the curve, but that curve is now absolutely flat. So do we actually invert again? We also did a 2-year auction. It seemed like it was a solid bid to cover ratio, although the yield was higher than the previous auction. And we get a 5 and we get a 7-year later on this week, bringing together about $114 billion worth of Treasury supply, guys. Zoom. Let me go to Zoom. Should we go to Zoom? Because
they're still earnings?
They're earnings, and they're changing their name.
That's all we know. They're going from Zoom video communications. To get this, Tim, wait for it. Zoom communications. So they're dropping the video. So I'm not sure what that means.
They don't want to limit themselves. No, they don't want to limit themselves. Optionality.
Is that because everybody turns off the video when they're doing the meetings?
I don't do that. You do that?
No, we're not allowed to do that here. This
Younger people do that. That's a Gen Z thing.
I do it. Don't you do it?
I didn't know you're really there.
Gen Z does it.
Sometimes I'm in my pajamas. I don't want anybody to leave it on.
Okay, while we wait for Zoom.
Can we talk private colleges?
Yeah, let's talk a little bit about some
Black
private schools.
Friday is coming. Things will be on sale. But right now, Tim, there's some private
Tuition?
colleges, tuition on sale.
Yeah,
on
so
sale? Wait, on sale. Like
don't get your hopes up. Don't get your hopes up. There's sort of 2 tiers of what's happening here, okay? So you got a college out in Minnesota, Bethel University. It's about $44,000 a year. Next year, they're going to only charge about $26,000. It's one of a dozen across the U.S. They're going to slash prices in an effort to bring in more students. Supply and demand, folks.
That's good. How much was it? How much was college when you went, Scarlett?
$20,000 a year.
20,000. How much?
16.
Yeah.
But it was much lower.
And I'm older than you, so I was even lower than that. So,
Now it's almost 100,000.
I guess that's a bargain. I mean, look. I mean, I guess you're saving, quote unquote, whatever, the 20 grand or whatever for this particular college. But at some point, you need the bigger colleges to get in on this. Otherwise, you're not really going to see much of the needle moved.
All right, let's go to Zoom, guys, because the earnings are out. It's changing its
Zoom
name.
or Zoom Video?
It's Zoom Communications, previously known as Zoom Video. Taking a look here at, let's see, fourth quarter earnings coming in. The range is 129 to 130. That's a little better than estimated. Their revenue forecast for the fourth quarter on the high end, 1.18 billion. That's a little better than estimated as well. And the stock though down about 6% on that.
In terms of full year outlook, Zoom Video or Zoom Communications now sees revenue from 4.66 billion. Well, I don't actually have the range, and now it sees 4.63 to 4.64. So we're talking about a really narrow range here.
Yeah, and this was the big question, of course, during the pandemic was how did they sustain that growth? Remember, they were growing something like 300% in 2021, also triple digits, I think, in 2022. And now we're talking about
a utility
2 to 3% growth.
Yeah.
And it's sort of like, well, what's the longer term story? And this is a young company, so it's not like, this is some mature company that can't find a way to grow. Where's the growth coming from?
I'm still wondering about this name change. Zoom Video to Zoom Communications. Is it because of AI? Here's what Eric Yuan said. A quote, at Zoomtopia, we announced Zoomtopia. Major milestones such as AI Companion 2.0 and paid add-ons for AI Companion and industry-specific AI customization.
What does that mean?
Further cementing our vision to deliver a differentiated AI-first network platform. It's about AI.
When
why didn't they just include
pivoted
AI
to the
in the
metaverse or something like that?
Here's a good headline. Zoom boosting its buyback by $1.2 billion. So we'll see.
Yeah, can I squeeze in another earnings? Leslie's, which makes pool equipment, ultimate discretionary spend, down 15% in after-hours trade. Big miss on a couple key metrics, including on EPS.
If only you had bought made a pool.
I tried to, but,
no one wants a pool. They already got their pool. They're done.
The condo board, was kind of...
They were not on board.
They frowned on that for the lobby.
Yeah, I don't know. You know how hard it was just to get a washer dryer in the...
Yes, I do.
All right, guys, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals Monday almost over. We will see you again, same time, same place tomorrow.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
I just want to mention, we talked earlier about all the stocks hitting 52-week highs just with our TV colleagues, and that included Zoom. It actually hit a more than 2-year high intraday in today's session, but it's now down about 3.5%, so it's bouncing around in the aftermarket after its results.
Hey, I want to shift gears a little bit, talk about venture capital, what's happening in the space, private equity, funds of funds. Here's a stat. From 2023, less than 0.5% of all VC funding awarded in 2023 went to Black founders. This is according to Crunchbase data. Women-founded businesses accounted for 2.2% of funding that year. That's according to PitchBook.
God, those are small numbers.
Tiny numbers. Lumen Capital is trying to change that. It's a Black-owned and led fund of funds that says it's, quote, working to achieve racial and gender equity across investing. Not just VC, but also growth and private equity funds. They've got a host of themes. They include education, financial inclusion, climate and sustainability, and more. We've got back with us Darren Dodson, managing partner at Lumen Capital. He joins us from Oakland, California. Darren, it's been a while since we spoke. How are you?
It's great to be back. Thanks for having me back.
We love talking to you. I want to talk. I just want to start. I know you have a new fund that you recently raised, so we'll talk about that. But I want to talk big picture here, because if we were having this conversation, maybe 2021, about representation when it comes to venture capital, I think the backdrop was a little different than it is right now. We've seen a lot of companies come out in recent months and get rid of DEI initiatives. Huge companies, small companies, they get pushback from investors. It's almost like this idea of actually talking about differences has become something that's a little taboo now. How do you look at it?
Well, I think one of the benefits is that we have of science is that we have an approach that's a research-driven approach at Lumen Capital. And when we look at the data, one of the things that we see is that high-performing Black-led funds are overlooked and underestimated at significant rates. So this is in partnership with Stanford. We look at 180 asset allocators and found this as a consistent finding. So what that means is that companies that might back away from this area also risk looking at the important additive portfolio alpha generating characteristics of having top performing Black-led companies and funds part of their strategy and focus. So that's an important consideration for those that would shy away from this area that's critical to help portfolios outperform.
Darren, help us out here. My understanding is that this latest Catalyst Fund was maybe almost just under $33 million. I'm looking at a story by TechCrunch. I just want to make sure I've got it right. That you've got in total about $285 million in assets under management. And then back in 2023, you did $168 million second fund to address racial and gender bias in investing. Am I getting most of the numbers right here? Or help me out here.
That's right.
So you've been doing this for a while, and that's a fair amount of money, right? Helping out entrepreneurs. What's happening? Like, where are these investments going? What's the reality of you make these investments and where they go? What kind of companies are created? Help me out. Tell me where this all goes.
So our new fund really enables us to look at direct investing, as about 35% of it goes into directs. Traditionally, we've invested in funds, which is where the other 65% goes towards. And we're looking specifically at first-time fund managers that have been associated with outperformance and overlaying our thesis of addressing bias in ways that unlock impact and economic value within the underlying funds. So again, the thesis of Illumine Capital is that if you're a pension fund or a sovereign wealth fund or a university endowment, all of whom we tested in our study and found systematically that they would overlook high-performing Black-led funds, we really want to enable them to have exposure to extraordinary entrepreneurs and extraordinary fund managers that they are most certainly, given the data of 1.3% of $82 trillion in capital managed by women and people of colored funds, they're almost certainly overlooking.
Where are you seeing the most opportunity right now when it comes to those numbers? Is it in the venture capital side or is it in the private equity side? Where is it?
I think within the venture side, there's a lot of explosion and growth, for example, within the Latinx community, leading new venture capital funds that are extraordinary in terms of being aligned with buying power trends that make up about 30% of the U.S. GDP over the next 10 to 15 years. There's some wonderful data out of the Latino Action Business Network. LBAN is what we call it. It's associated with Stanford and kind of founded to look at 4 million companies per year and survey them on the bias that some of them face in terms of raising capital, either from banks, but particularly for this conversation, from venture capital funds.
So can I just ask you though, is it too early to see the impact that you guys are having when it comes to racial and gender bias, whether it's in hiring, investment? Like, I'm just curious. I know sometimes it takes a while for things in terms of the payoff, and I use quotation marks, but I'm just curious what impact you are actually seeing when it comes to gender bias or racial bias.
Well, we've seen the fund managers that we work with hire, promote, and retain extraordinary people. We've seen them select investments that would suggest that they're addressing bias within their overall selection process. And then finally, we see them create boards that really reflect the entire world and not just a sliver of the market. So those are really important areas where we expect over time to align with some of Charlie Munger's core thesis of compounding knowledge, which we work with all of our fund managers on, the strategies to address these biases and learn and commit to learning over time. And we expect that returns will follow as a part of our core strategy. It does take time, as we might learn from Warren Buffett and Charlie Munger, who have compounded returns over substantial amounts of time. And we see that also within our strategy, that the learning is followed by this commitment to achieve higher returns.
So let me ask you something, because I think about your mission is so clear, right? And you're putting your money where your mouth is, and you know what I mean, really trying to make this difference. I am curious too about a recent story that's been in the news. You're on the board of Ben & Jerry's, and the independent board of Ben & Jerry's has accused its parent company, Unilever, of silencing it on advocating for Palestinian rights in contravention of an agreement between the two. So I'm just, I guess we're all just trying to figure out where we are in this world. What's your thought about this?
I can't comment on an ongoing lawsuit.
Okay.
Can you take us into at all the discussions that you were having ahead of the lawsuit with the board and what you were hearing, what you were talking about?
No.
It's okay. Next time, Darren.
No, I guess, it goes...
I respect it. I understand.
We do. And I guess we're trying to understand, the bigger picture because of, certainly coming off the pandemic, of the murder of George Floyd, and just so many big corporate companies and their executives coming out and talking about the importance of this.
The reversal that we're seeing now.
And the reversal. So is it a complicated time? And we've just got about 30 seconds. I mean, you understand this, I think, from a very different perspective than most. And I'm just curious what you think.
Well, I think that given the political polarization right now and the increased inflation and also the real challenges with economic volatility, as a lot of folks are uncertain about the times that come. One of the things that we're sure of at Illumine Capital is it's environments like this that increase overall bias. within heuristics of allocation portfolios. And one of the things that we're really proud of is enabling our investors like Health Ford Foundation and Ford Foundation to make even better investment decisions by focusing on addressing bias.
Thank you so much. Always appreciate time. Darren Dotson there.
It's 421 on Wall Street. We do check markets all day long here at Bloomberg. We got earnings from A to Z, and we begin with Agilent. The electronic measurement company reported adjusted EPS for the fourth quarter that had beat the average analyst estimate. After ours, right now, we got Agilent unchanged, but also reporting earnings. Zoom Video boosting its revenue guidance for the full year. That guidance did beat the average analyst estimate. Company now wants to be known just as Zoom. After ours, we got Zoom down now by about 0.9%. It was an update today for the Dow, the S&P, and the NASDAQ Composite Index. S&P advanced 18 points, now at 5987, holding close to 6,000, up by about 0.3%. The Dow up 440, up by 1%. NASDAQ up 51 for the NASDAQ Composite Index, a gain today of 0.3%. The 10-year, 4.26%. The 2-year also at 4.26%. Gold down $89 the ounce, down 3%. 3.3%. West Texas Intermediate crude down 3.1%, 69.06 a barrel. And Bitcoin down 2.2%, 94,853. So again, recapping the Dow, the S&P, NASDAQ, all higher. S&P up 18, up by 0.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, thanks, Charlie. Do appreciate that. Let's talk about burgers.
Let's do that.
Okay, first up, we Americans eat a lot of them. About 50 billion burgers per year.
It's a lot.
Did you add this in? Did you edit my...
I did. You said read it, and I did, and I was like, I'm just curious. I just like sat there, and I'm like, I wonder how many burgers we eat. You had a burger in the past week. I had a burger in the past week. I was thinking it was a burger.
That's an average of 2.4 burgers per person per day. That doesn't make sense.
Okay, that doesn't make sense. Okay, my statistics are a little flawed, apparently. All right, can we just stick with the 50 billion? All right, talk about cost.
Okay, I'm going to read the part that I wrote.
Okay, that was not Tim approved. Okay. This is Tim approved.
When it comes to cost, in the second quarter of 2024, the average price of a fast food restaurant burger was $8.41. It's up 16% from 5 years ago. That's according to the food consultant Technomics Ignite menu data.
That's a lot.
It's not just McDonald's, though. It's like, even at McDonald's, I should say, the price of a Big Mac. So no fries, no drink, just the sandwich. In June, Carol, that was up to $5.29, a 21% increase from 2019.
That's a lot. So beef may be what's for dinner, but it's more expensive than it used to be. I know it. I just go to the supermarket. You just get a feel, or even when you order it. So we have a guest who probably has some thoughts about that.
Yeah, Pat Conlon watches beef prices closely. He's president of Wayback Burgers, the fast casual chain that, yes, specializes in burgers, fries, shakes, and such. They've got about 150 locations here in the U.S., another 20 in countries including South Africa, Japan, Canada, and more. Pat, good to have you with us. How are you?
Thanks for having me.
Okay, so let's start with where Wayback fits in, because there's no shortage of burger options out there, from fast food to sort of the high-end gourmet and everything in between. Where do you play?
We play in the fast casual segment. In the
So
better,
the Shake Shack
better burger. Shake Shack,
Bear
Five
Burger.
Guys.
Okay.
We're still waiting in Manhattan. I'm just telling you.
Yep, very soon. You won't have to wait much longer. We're going to open up our first Wayback restaurant in Manhattan on 7th Avenue and 27th Street. Should be in January, right across from FIT. So then you'll be able to get one of those 2.4 burgers per day.
I don't know what that means. I'll have to double check on that. But talk fast casual, because, you know, we talk about Chipotle, who is often credited with really creating it many years ago in terms of fast casual. It wasn't just the fast food places that we got accustomed to. It was a little bit of an experience.
Right. When I grew up, it was really fast food, and now fast food's called QSR, quick service restaurants.
Yeah.
Fast casual started really with Chipotle, Panera Bread, higher quality, elevated food, elevated experience in the restaurant, more fresh. People wanted a better quality burger, better quality salad to go to, and they're willing to pay more for that quality, but also for the overall experience and the atmosphere of the restaurants.
How do you replicate that atmosphere of the restaurant in New York, where rent is super high, spaces are small, and crowds are aplenty?
You have to be fast. So even though we do the order, we don't pre-cook any burgers. We make the burger when you order it at the point of sale system. But it's really, nowadays, the digital ordering process is a big portion of our business. So people ordering ahead on the app.
How much of your business is that?
It's about between the app and online ordering and delivery. It's about 40% of our business is digital orders.
How much is that up just in the last few years?
Wait, online, app, and delivery are 40% of the business?
Correct.
Okay, forgive me. Go ahead.
And when you do delivery, are you doing third-party delivery?
Third party through Uber Eats, Grubhub, DoorDash.
Do you hate that and paying all those fees? Can I just put it out there?
We pay the fees.
I know, but
both of us pay the fees.
Yeah.
The restaurateur pays commissions to those services, but we don't. I mean, if you had to start a delivery service of your own, there's a cost involved in that as a restaurateur. Delivery guys, insurance, cars, things like that. So there is a value to having them, and they bring certain guests to, maybe not to the restaurant, but they bring those sales into the restaurant, because there are certain people that are only going to order delivery. And when I was a kid, the only thing you could get on delivery was Chinese food or pizza. Now you can get everything under the sun.
It is so true, right? In
Yeah.
terms of diversity. I have to say something, excuse me as I blow my nose, sorry, I'm getting cold. Five Guys, In-N-Out, Wayback Burger, Smash Burger, Burgerville, Fat Burger, Johnny Rockets, Whataburger, Red Robin's, Hardee's, Jack in the Box, Wendy's.
Well, now you're getting to some fast food.
Okay,
Yeah.
but I'm just going to say, there are so many burger joints out there. How do you, I understand fast casual and experience, but how do you stand out? Like, what's your fear about coming into a New York market when I can also go to PJ Clark's and get a burger with béarnaise and be at like kind of an old speakeasy and have a really cool experience? But tell me how you do it.
Well, it has to be done, I mean, in the fast casual segment, and even in the QSR, quick service restaurant service now, quality, everybody has quality food. Okay, so
No, everybody does not have quality food. But go ahead.
everybody has some semblance of quality, or
There are
people
some
expect.
regulations.
She'll fact check you.
People expect quality for the level of price they're paying.
Yeah, okay, fair.
So you have to have something other than just quality food. You have to have the atmosphere. You have to have that guest service. We don't call the people that come into our restaurant customers. We call them guests because we really believe that they're coming into our dining room at our home. When you order at the POS station, we don't give you a number, we take your name. So it may sound a little bit goofy, but it's a little bit different personalization. So then when we walk the food out to your table, we say, Pat, you know, double cheeseburger, not number 21, number 27. So it just, you know, makes you feel a little bit better as a guest. And then if you walk in and that person behind the POS system remembers your name, or maybe they remember that you get a bacon double cheeseburger all the time and an Oreo milkshake, and they say that and you're in with somebody and they catch your name, or hey, you're getting that thing, that same order makes you feel like a king as the guest. So that's how you have to differentiate yourself today in the market. We know we have a great burger. We know we have great hand-dipped milkshakes made the old-fashioned way in a metal tin, spun, not pulled out of a machine. So we know we have quality food. It's that other atmosphere and that sense of nostalgia that's going to set us apart.
You're a franchise guy.
Yes.
That's
all my life.
Your whole life, yeah, your whole career. What's the franchise model here?
In terms of?
So how does it work? I mean, are these all independently owned and operated? Are they company stores?
No, we're 100% franchise.
Okay, 100% franchise. So an asset-light model for you on the corporate side. How do fees work?
The
franchise fees.
Initial franchise fee, the license to open up a restaurant, is $35,000.
Okay.
Your ongoing royalties are 5%, and the advertising fee is 4%.
That's pretty typical to the industry.
Correct.
So all you need is $35,000 up front in order to do it, plus the capex that you need to build out your location.
Yeah, the total investment is between $550 to $650.
Okay.
Including the franchise.
How do you explain the footprint where restaurants are right now in the U.S.? Is that because of who you found as franchisees? Is that deliberate? It's definitely, there are a lot, but they're concentrated in certain areas.
Yeah, we concentrate, except for the one that we're doing in Manhattan. We started in 1991 in Newark, Delaware. We've always been very successful in small towns. We are opening up the one in Manhattan, opening up one in New Orleans. So those are really our first forays into downtown areas. And we've been successful, but now through that downtown, through those small markets, now we're growing into the cities.
Who are you seeing as your typical franchisees? Are there a handful of people who have like 10 of them, or are they sort of one-offs?
No, we're a little bit different than some other franchise companies. We look to award one franchise at a time, where many other companies want you to come in and do 5 or 10 or take down a whole county. We want to be in business with you first, see how you do, see if you're happy with us, we're happy with you. We're all about growth, but we want to make sure we're growing with the right people. So we do one at a time.
Does that mean you do have some franchise operators who have more than one?
So now, over those years since we've been franchising, since 2008, we're about 45% of our system are multi-unit franchisees. So they've reinvested in the brand and themselves. They know that it's working, and they're happy, and we're happy with them.
And you do stuff over internationally, too, like Brunei, Ireland, South Africa, Japan, Canada.
Yeah.
And you're continuing that. Like, how do you what's that model? And
that model's model's a little bit different than the franchisee in the U.S. It's done by a master franchisee, and that person or that company actually becomes really the parent company in that country or that territory or that province. So they have to do everything that we do in the U.S.
Interesting. How quickly does somebody who sets up a restaurant, a franchise, and how quickly do they get their money back?
Really depends upon how they set up. If they're an owner-operator and they're taking a salary, or if they're multi-unit owners, it's a different payback and how they set it up financially, whether they're paying all cash for it, using their own money, or if they're going to the SBA or a lending institution for financing.
Is the model such that the franchisee is actually in the back working, getting his or her hands dirty?
No,
Does that need to happen? There's some chains are notorious for that.
They need to know. Yes, they need. When you become a franchisee, you're going to have to learn how to flip burgers and drop fries and make milkshakes. The reason being, not that that's going to be your function as a franchisee. Your function is to grow your business and to get a new guest every day. But you need to know, because when you walk in or when you look on a videotape and you see that the side of the floor is dirty because they've been hitting it with the mop and not cleaning that, you need to walk in and be able to catch that. So you need to go through the full training process. But no, we don't expect our franchisees to be in behind the grill every day. That would be a waste of their talent and their training.
We got about 30, 40 seconds, and then we're going to take a break and come back and talk some more. Do most franchisees work out, or are there a small percentage where it's just obvious? Because you got to worry about the brand, the reputation. One bad one can bring it down. So I'm just curious, do most of them, like 90% of them, work out?
Most of them, yes, they do work out, and we have a great family of franchisees across the U.S. and across the world. Yeah, there are some times where people either decide this isn't for them, or it is a lot of work. The restaurant business is a lot of work.
Yeah.
And you also have to have a personality to be in the restaurant business. It's not, you're not behind a desk. You have to be, out there, front man. And if that's not for you, then you shouldn't get into the restaurant business.
Sit tight. We're going to come back and continue with Pat Conlon. He's president of Way Back Burgers. He's here in our interactive broker studio. I want to get into, too, a little bit about what's changed, what's different from the 90s when they set up, because the model has certainly evolved. More to come right here on Bloomberg.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. It was an update today for the Dow, the S&P, and NASDAQ, right to the numbers with the S&P up 18. That was a gain of 0.3%. The S&P very close to 6,000 once again, 59.87. Dow Industrials up 440, a gain of 1%, finishing the Monday session in a holiday-shortened trading week at 44,736. NASDAQ up 51, a gain of 0.3%. 10-year yield, 4.27%, with the 2-year today, 4.27%. Gold down $90 the ounce, 26.26, lower by 3.3%. And West Texas Intermediate crude down 3.1%, 69.06 for a barrel of WTI. Bitcoin today fell another 2.8%, 94,289 on Bitcoin. As for the outlook for the Federal Reserve and rate cuts, Jim Schmigel is Chief Investment Officer at SEI, and he was a guest on Bloomberg Business Week.
The Fed put themselves in a little bit of a bind. When they came out of the gate with 50, totally unnecessary. I think they're locked in for December. I think it would be odd from an optical perspective to come out with a 50 basis point cut, do a 25 after the election, and then pause. So we'll probably get another 25 basis point reduction in December and then start talking about skipping meetings and pausing in early December.
Jim Schmigel, Chief Investment Officer at SEI. After the bell, Zoom gave a sales forecast for the current quarter that failed to impress investors who were expecting a bigger boost from the company's expanded suite of products. Zoom right now down by 1%. Also, by the way, announcing a name change, slightly, no longer known as Zoom Video. It'll just be known simply as Zoom Communications. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Want to get back to our guest. Still with us, Pat Conlon, president of Wayback Burgers, 150 locations and counting in the United States. And I'm just going to tell you, we're still talking about that 2.4 burgers per day. I have found it, USDA data. I have never been grilled so hard.
Ooh, I like what you did.
The little pun.
That was really good. Okay.
Pat, talk to us about some of the logistics of, as Tim rightly pointed out, it's franchisees, so asset light. But I am curious about food costs, labor costs, building out in, as you said, you're getting ready to open up or have one location in New York City. It's expensive here in New York City. Talk to us about some of these dynamics.
Yeah, well, the food cost is, again, one of the reasons you get into a franchise model is we go out and we negotiate for 150 restaurants for beef, for buns, for ice cream, for soda, for all the supplies. So you're not, if you were going out and just negotiating for yourself, you wouldn't get that volume discount purchased. It also talks to the quality of the product because we're getting the quality, the consistency. So you get that same burger, the McDonald's theory, whether you go to one in California or whether you come to one in New York or Florida, you get that same taste. Same thing with Wayback. It is the same product across the U.S. So you get the volume discount in the pricing. You get the same quality and the consistency which the guest is looking for when they walk into a Wayback or any franchise model. And I forgot what the other part of your question was.
Labor costs.
Labor costs.
And even overhead of building out. It's not going to probably cost the same to build in New York versus maybe somewhere else across the United States. Or does it? I don't know.
No, New York City is a different animal to itself, but it was an existing restaurant, so those are some of the spaces that we look for around the country, as long as it can't compromise on the quality of the location. It has to be a number one location, AAA location, and if it was a restaurant location, great. You don't want to take a second-generation restaurant that went out of business because it was a bad location, but it's going to save you $50,000 in build-out costs.
So you do research. You're like, okay, who was here beforehand, right?
Yeah, and why did they go out of business? Is it in the back end of the shopping center? Was it a bad shopping center? Can you make a left-hand turn? Is there a light to get in, to get out? Or are you taking your life in your hands if you have to pull your car out of that shopping center? So we do all that research along with our broker networks. We have a real estate platform, a modeling platform that looks at the locations that we're choosing with the franchisees. And we hold their hand all the way through that. You asked earlier what type of people are coming into the system. It really spans the horizon. There are restaurant people that come in. There are people that come out of corporate jobs. There are people that come out of IT. It's really all across the board. but we have the training programs and the systems to be able to make them successful.
Okay, lots of questions here. You mentioned labor.
Yeah.
Yeah, I want to hone in on that a little bit because we've seen labor costs over the last few years go up quite a bit. It's been tough in some markets, even finding the labor. What's the labor picture you're hearing from franchisees right now?
One of our franchisees told me about 6 months ago that I said, and our first franchisee opened up in Utah about a year ago. And I asked him, is there any labor problems, labor issues, finding labor in your market? And he said, Pat, there's no labor issues. It's you have to pay what the going rate is in the area. And that's really what it comes down to. If a restaurant down the street is paying 25 cents more an hour than what you're offering, you're going to have a labor problem. Minimum wage is a fictitious number. There is no minimum
because the
wage.
market determines that.
Correct.
We found. But if, let's say, your franchisee in a part of Utah where the cost of living is higher has to pay a higher wage than somebody based in, let's say, a Sunbelt state where you have a store, where the cost of living is lower, is that reflected in the actual menu price too? Do they have discrepancies, or do they have the ability to have discrepancies within menu pricing?
Absolutely. We don't force them to charge X amount for a burger or a milkshake. Labor has to be taken into account, just like rent has to be taken into account. The rent in New York City is going to be much different than the rent in North Carolina. That has to go into the menu prices. The food cost goes into the menu prices. We were talking earlier about the price of beef and the price of proteins and how that has gone up over the last 3-4 years. So that has to be accounted for, and you see that in menu prices and inflation and things of that nature.
I was looking at the menu. The menu looks great, by the way. It got to a part though where it had the non-meat burgers. Carol and I used to talk about these all the time.
Now it
Does anyone order these anymore?
That's a great question.
They still do. The Impossible.
The Impossibles and the Beyonds.
Yeah, the plant-based. We carry the Impossible Burger. And probably 3-4, it's just right around the pandemic is when we brought it on.
That's when it was hot.
Yes, and it probably went up a couple of years after that. It's funny, we had it on as a limited time offer just before the pandemic hit. And we weren't sure how it was going to go. And it was also going to be an expensive menu item because that product was an expensive item to bring into the restaurant. And it turned out to sell very well. And we took it off because we had a limited amount of supply of it. And never saw so many feedbacks 4 or 5 years ago. When are you bringing that back? The only reason I came into a burger place was I saw that you had that online. Now that has definitely waned, and the plant-based meat alternatives have gone down somewhat.
It's so I don't know about you, Carol, but I went from I loved those things, and then I kind of realized what was in them. And
I was never a fan.
For me, now I'm like, give me the cow.
Yes. I was never
Give me the cow.
No, because I thought the amount of salt that was in it, and I had so many conversations with folks that were in the industry, and I'm like, I should be your customer, but it isn't a healthier option.
Yeah, we have. Well, it's
At least
really for people who are not they're not vegetarians. They like meat. They like the taste of meat. They were looking to cut down their consumption of meat and going that way. So it worked well for us.
So I'm looking at a sweet bacon burger that's just oozing with bacon and cheese. Looks kind of yummy. Cheese fries. Yep, give me some fries.
Get the bacon on the fries.
I'm just saying, what happened to people wanting healthier fare?
I think this is looked at as healthy now.
Come on. No, to be fair, like,
we gotta
healthy.
we gotta ask RFK. What's healthy?
We've only got about 30 seconds. Like, what?
People looking and they want to eat healthy in January when they get their gym membership and when the calendar changes. Come February, everybody's back to eating those 2-3 burgers a week.
Sorry, go ahead.
No, or 2.5 burgers per day.
2.7.
I'll take the 2.7.
I'm just saying. Really interesting stuff, and fun to hear you kind of talk about your business. And we didn't really get to say how it's changed from '91, but come back soon.
Yes, definitely. Thanks for having me.
But bring
we'll
some
still be
cheese
doing
fries.
math. When you get back, we'll still be working on this math problem, okay?
It's right. We'll get into it.
Carol, I do want to bring up a redhead crossing the Bloomberg terminal. Ken Leach has been sued by the SEC over alleged, quote, cherry-picking scheme. The former WAMCO co-CIO sued over scheme to allocate trades. We'll dive into this a little bit and give you some more information as we do get them. Right now, it's just headlines, though, crossing the Bloomberg terminal.
All right, you're listening and watching Bloomberg Business Week, and this is Bloomberg Radio.
listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
All right, everybody.
We had to
Bloomberg
keep
Business
him.
Week.
We had to keep him.
And I want to do like a little bit of a rapid fire because I feel like all of a sudden
Got a lot of
it's like we both had a cup of coffee or 2.5 burgers per day. We like hit our quota.
We're also sharpening our pencils, hitting the TI 83s.
Pat Collins.
We got a
still
whole
with us.
team on these numbers doing the stats for us.
Pat Collins still with us, president of Wayback Burgers, Bloomberg Interactive Broker Studio. First of all, private equity money that keeps getting involved into different worlds, good or bad?
Some of it's good, some of it's probably not good. We're very much about, we're not private equity, we're owned by two partners, and no debt on the company.
Which own what? Like
They're the franchise, we're the franchisor.
So they own the
Jake's
concept?
franchising.
They own
Yes.
the concept?
Yeah.
Okay.
They own the franchising company is called Jake's Franchising, and we're the parent company for Wayback Burgers.
What'd you think of the Jersey Mike's
Yeah.
purchase?
Blackstone
By Blackstone
buying
$8
it.
billion.
Yeah.
Huge amount of money, but we'll see what happens. You know, that's what the valuation, if you look at it per location, is pretty high.
So did Steve Schwartzman overpay?
I don't know. I guess we'll see in the years to come.
The business, like I think about margins. How tight is it in a restaurant? What are the margins like?
It's tight. You have to watch your food cost. I mean, our burgers. I think you were asking what's changed over the years.
1991, you guys started,
Yep.
right?
So it started originally in Delaware, but when the beef came in, it came in bulk, and you had to roll. They called it rolling burgers. So you rolled them into little meatballs because it was all fresh burgers. So you did that in the back of the house, and you had to weigh each meatball burger before we pressed it. And the problem with that is
Kind of like my mom did, but she kind of like just
right what you did at home, except your mom didn't put it on a scale.
No, she didn't.
And if one was bigger than the other, it didn't make a difference at home.
Yeah, my brothers got those, and I got the smaller burger.
In the restaurant industry, again, you want consistency, but the problem is if that burger goes out bigger, then it's costing you more as a franchisee. If it goes out smaller, then the guest is not getting the
Tim
right
is ticked
value.
off that his burger's small.
That's right. So we
what
went
do
to
you
our
do?
burger supplier after years of doing it, and it was a labor issue, rolling beef, and nobody wanted to do it, and it was the employees didn't like doing it. So we went to our beef supplier and said, and quite frankly, it was a food safety issue having hands on it, and we went to our manufacturer and said, is there a better way? And they said, yeah, you know what, we've just started doing this where we can make your proprietary beef in a loosely formed puck, they call it, and at your weight, your specifications, and it'll come into you cryovac, and each patty is already done. So you take it out of the back of the house. So that's a labor savings, it's a food cost savings, because
It
now...
costs you a little bit more, though, right?
No, it costs the same amount of money.
Really?
They'll just pre-measure it for you.
They pre-measure it.
Vacuum
It saved
seal
us a lot of money. Yeah.
Wow.
And now there's, the team members loved it because, and the franchisees loved it because you're getting people out of the back of the house. So you're better able to serve guests in the restaurant. Same thing with our ice cream. We hand scoop the milkshakes. And the ice cream that we used to use was a vanilla bean ice cream. It sounds funny, very, very hard, even though it's frozen at the same amount, and nobody wanted to do it. You had to take the tub of ice cream out and sit it on the counter in the back for a little while, let it thaw out a little before the team member could scoop it. And you were scooping hard ice cream. It was tough.
I think about that with folks who are doing ice cream. It's a lot of work.
It is.
I'm getting some questions.
So what were you going to say? Did you automate it?
So we were eventually looking at that, but we went back to the ice cream guy and he said, we can make an ice cream with a little more sugar content, and believe it or not, it's softer. It's still at 10 below zero, but it's softer. You can take that out at 10 below, and you can scoop it, and you can almost scoop it to order.
We only have a couple minutes left, but I'm getting some questions from folks listening and watching right now. As the person who's the president of the franchising firm, do you have a view on unionization at all? We're seeing it happen at places like Starbucks, for example, Apple Store.
Yeah. Look, I mean, we're in the hospitality business and the restaurant business, and we want to make our we're also 100% franchised. So it's a little bit different than Starbucks, where they're all company-owned units. So we want to make our team members, we want them to be fairly paid. I don't know whether we would take a stance one way or another on unionization.
All right, so if we're coming, is Tim a garden burger? Is he a Carolina? Is he a Cajun? I know I'm an A1 steakhouse.
I mean, I would do any of the above. I was looking at the menu earlier.
Well, also look at the cheesy, which is very plain, but it's 4 slices of American cheese on a double patty burger with an inverted butter bun.
That's magical.
Yes.
No offense, I've done that with hot dogs and buttered buns.
It's a grilled cheese with a hamburger in the middle of it.
Okay, only 30 seconds. Technology, kiosks in stores. What's going on?
Kiosks in stores. We started, again, that came out of the pandemic. We have about 50 restaurants across the U.S. today that have the kiosk. Every new restaurant that's being built with kiosks. It's not so much of a labor savings, but redeploying the labor in the restaurants so that they can better serve the guests.
5 seconds, consumer doing okay?
Yeah. Consumer or?
Consumer. Shopper, yeah.
Shoppers doing
Restaurant,
okay?
Person who comes to a restaurant, you think they're doing okay? They're not pulling back or anything?
No. I mean, we see that our sales haven't slipped. So
good stuff.
Knock wood.
All right, well, when New York opens, come on back.
Definitely.
All right.
We'll meet you there for a burger.
Deal. Pat Conlon, President of Wayback Burgers. Thank you so much. Really enjoyed it. That's going to do it for Tim and me. Folks, have a good and safe evening. Do not go anywhere because Balance of Power starts right now.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
From Bloomberg's Washington, D.C. studios to our TV and radio audiences worldwide, welcome to Balance of Power. I'm Kaylee Lyons. The Justice Department officially dropped the federal criminal cases against Donald Trump in both Washington and Florida, in keeping with DOJ policy not to prosecute sitting presidents. This after Trump dropped a deluge of nominees for posts in his second administration on Friday night, including Scott Bessent for Treasury Secretary and Russ Vought for the Office of Budget and Management and Budget. We'll get reaction from Maya McGinnis of the Committee for a Responsible Federal Budget. Plus, I'll be joined this hour by former U.S. Defense Secretary William Cohen as Israel and Hezbollah are reportedly closing in on a ceasefire agreement in Lebanon. Thanks for joining us on this Monday evening. We begin with our top story, the DOJ dropping the pursuit of criminal prosecutions against President-elect Trump. Special Counsel Jack Smith filing the paperwork this morning to end the 2020 election subversion case in Washington and the classified documents case in Florida. Judge Tanya Chutkan here in D.C. granting the dismissal of her case this afternoon. Trump responding on social media saying, quote, "These cases, like all of the other cases I have been forced to go through, are empty and lawless and should never have been brought. Over $100 million of taxpayer dollars has been wasted in the Democratic Party's fight against their political opponent, me." Trump going on to say, "It was a political hijacking and a low point in the history of our country that such a thing could have happened, and yet I persevered against all odds and won," end quote. For more, I'm joined now by Bloomberg's Mario Parker and Bloomberg's Texas Bureau Chief Julie Fine. Thank you both for being here. Mario, to begin with you, obviously this was the first time in history we had seen a former president indicted on federal charges, and it seems like almost just as quickly and just as historically, it all goes away because the American people voted for him.
Yeah, no, that's absolutely right. We saw similar things happening last week as well. I mean, it's over with. This is a done deal at this point. Jack Smith said that it was categorical that presidents have immunity in these instances. It's not a surprise given that he won the election. Just practically, he would be 81 years old when he leaves office. It would have been about, 4, 5, 6 years since this all had transpired as well. So even from a practical standpoint, aside from just immunity in office, it just doesn't seem feasible.
Yeah, and of course, in the New York case in which he was convicted, that sentencing has been postponed indefinitely. But he was a convicted felon, became one in New York, Julie, and ultimately he still was able to win the Electoral College and the popular vote. He effectively used all of these indictments and ultimately his conviction as a way to benefit his campaign.
Absolutely. They were always big fundraisers, too, as you remember. Right after that happened, the fundraising email would go out, and the former president, now soon to be president again, raising a lot of money off of them. But Mario, you hit it right there on the head. It's over. He's going to be president. There's clearly presidential immunity in these cases, according to Jack Smith. And so that's why this has happened.
Well, and as he is going to be president, he is quickly getting his second administration formed with a number of names dropped on Friday evening, prolonging the work week for a lot of Washington journalists last week, Mario, but including, of course, the one we all were waiting for, Scott Bessent for Treasury Secretary. The market welcoming this with fairly open arms today, it seemed, and that's really what Trump was trying to achieve, right?
No, absolutely. One of the things that I think that we saw is, as much as Trump wants to be a disruptor in Washington, one of the things, if you remember from his first term in office, he often used the Wall Street and the markets as a barometer for success. He did not want to have headlines where he picked someone and then the markets crashed. Scott Bessent is viewed in the markets as having been quite sober, professorial as well. His background, I mean, he's bet against treasuries before, against currencies around the world as well. So he knows the financial instrument that he has at his fingertips now.
So he may be one that it will be relatively easier to confirm, it seems. For other choices, though, perhaps it's a bit more difficult, including the selection of former Congresswoman Tulsi Gabbard to be the director of national intelligence. Yesterday on CNN, the Republican senator from Oklahoma, James Lankford, who of course is on the Intelligence Committee in the Senate, spoke about the confirmation process for Gabbard in particular. This is what he said.
Well, we'll have lots of questions. She met with Bashir Assad. We'll want to know what the purpose was and what the direction for that was. As a member of Congress, we'll want to get a chance to talk about past comments that she's made and get them into full context.
So, Mario, now that we've had pretty much all of these other high-level positions filled out, is it still her, RFK Jr., and Pete Hegseth who have the most difficult path to confirmation?
Oh, no question, right? So, I mean, the fact that Matt Gaetz withdrew his nomination, in some ways there's a school of thought that there could be four, right? There could only be at least three of those less than palatable nominations that you send over to the U.S. Senate. But make no question about it, you've got those people, those folks in the Senate, Susan Collins, John Cornyn, Lisa Murkowski, others, who will have some questions about some of these nominees. Again, Tulsi Gabbard, when you think about the foreign policy record, RFK Jr., and some of the more extreme things that he said about health and human services as well.
And I do wonder, his pick for Labor Secretary, Laura Chavez DeRemer, who, of course, is a current congresswoman from Oregon, is getting some pushback from conservatives for being too pro-union. That might take Democratic votes to get over the finish line.
Getting some pushback from conservatives, but in this Washington that we live in now, ironically getting support from the likes of John Fetterman, right?
Yeah.
So maybe we'll have some, she will have some Democratic cover there.
And of course, those are just for the appointments, the nominees, Julie, that do require confirmation from the Senate. There are plenty of others that Trump has named to be close to him in his second administration that won't, including the person who's going to be his border czar, apparently, Tom Homan. And he's going to be in your state of Texas tomorrow to visit the border. What are we expecting?
Well, he's making 2 stops at the border. He'll be in Eagle Pass. He'll make another stop as well. That is the first stop in the morning. Listen, I expect him to talk about the border. He's going to thank the agents that have been working there. He's going to be with Texas Governor Greg Abbott. I think him coming down here, though, this early is a way for him to say, I'm serious about this. I'm already on this. I'm working on this. You know, it's a statement visit right before Thanksgiving to thank everybody that's working on the border. He has a lot ahead of him, so I expect him to say that. I also, if he takes questions tomorrow, it may be interesting to see if he reveals any of the plans that he's going to make. Again, the former president, soon to be president, in somewhat of a honeymoon period right now. Not sure he is going to want to say anything that would affect that.
All right. Well, we'll look out for that in Texas tomorrow. Bloomberg's Texas Bureau Chief Julie Fine alongside Mario Parker here in Washington. Thank you so much. Another story we're following today, California's Governor Gavin Newsom unveiling plans to offer state incentives to buyers of electric vehicles if President-elect Trump repeals a federal subsidy. But the proposed consumer rebates would exclude Tesla models, a decision aimed at spurring greater competition and allow more car makers to enter the EV market. The decision may heighten tensions between Newsom and Elon Musk, who have already clashed over California's politics. Tesla still accounts for more than half of all new EVs sold in the state. Still ahead, we'll turn back to Trump's key nominations that could help shape economic policy and government spending. Maya McGinnis, president of the Committee for a Responsible Federal Budget, joins next on Balance of Power on Bloomberg TV and Radio.
But I do want to, again, make sure that on day one, come the next 119th Congress, that we're giving President Trump the best success plan. And all of that is going to have to, kind of come colliding in with the end-of-year priorities for the Farm Bill. We're already talking about what the tax bill for next year is going to look like. So we just want to make sure that we're doing this right.
We need to have a robust tax bill that is focused on economic growth, that does, work to reduce the deficit. Under the Tax Cuts and Jobs Act, we've seen record revenue. So we do have a spending problem here in Washington that we need to get under control.
Republican members of Congress Ashley Hinson of Iowa and Mike Lawler of New York here on Balance of Power last week, talking about what a new tax bill might look like in the 119th Congress and the funding battles they still have to sort out in the 118th. Joining me now for more here on Bloomberg TV and Radio is Maya McGinnis. She is president of the Committee for a Responsible Federal Budget. Maya, if we could just first begin with the work that has to be done before the year is out. It seems that we're either going to end up with an omnibus package or a continuing resolution and kick the can down the road once again. Are either of those things fiscally responsible?
Well, it depends what they include in them, whether they're fiscally responsible or not. But both of them are 100% a reflection of the fact that our budget process is beyond broken. We should have passed a budget. We're well into the fiscal year, and we should have passed a budget last spring, let alone by the end of the year and the end of September. So no, the fact that we're even considering the two of these is just a sign that we don't budget the right way at all, and we're not dealing with these big issues. And there's still a very large risk, no matter which they choose, a CR and omnibus, that they are going to fill it with additional debt-financed policies. And that's where a big risk is for the end of this year.
Well, so then as we look ahead to next year and what's going to happen with the budget and debt, obviously we've gotten a ton of names dropped from Donald Trump in the last few days, including Russell Vought reprising his role as OMB director. And I wonder what that makes you think, Maya, about the way the budget process is going to play out in 2025 and beyond.
Yeah, so Vought has been there before. We've seen where his priorities are. He's looking very closely at some of the roles that the executive agency can have. But what we did see when he was the director of OMB before is that it was a period, not even counting COVID, but when spending grew very, very significantly. One of the things to remember about the last Trump administration was that there was obviously an emphasis on large tax cuts where they passed the TCJA, that added to the debt. But right after that, there were huge spending increases to about the tune of $2 trillion. And so one of the things we've seen is that there hasn't been a big emphasis on cutting spending. In fact, under President Trump before, spending went up significantly. The big question mark is whether they will focus more on spending cuts this time around, because clearly the spending is on an unsustainable path, as is the national debt.
Well, and presumably the Secretary of the Treasury is going to have a role in this as well, Maya. He has tapped Scott Bessent, who has talked a lot about this kind of 3-3-3 policy strategy. Two of those threes relating to the deficit in some way or another, as we consider the fact that he wants to see 3% GDP growth, yes, which he thinks tax cuts will inspire, but he also wants to cut the budget deficit as a percentage of GDP to 3%. Can he get both a permanent 2017 tax cut package and a lower debt to GDP? Can he have both of those things?
He can get certainly a higher level of growth and lower deficit. That 3-3-3 plan, it sounds great. It's very, very tough to get to those numbers. But just moving in that direction would be huge amounts of progress. The real question here is whether they are going to insist that the tax cuts are offset. If you just add them to the debt and you add the $3.9 trillion or more, not only is that going to make 3% deficits impossible, which it's already going to be very hard to achieve, it's going to add to the effects, the headwinds against growth. So tax cuts help grow the economy. Higher levels of debt harm economic growth. So the best way to grow the economy is if you want to cut taxes to make sure it's not adding to the debt, it's not debt finance, but it's offset either through base broadening or spending cuts. The future Secretary of the Treasury has talked about this and written about this. He is somebody who does care about fiscal responsibility an awful lot. So I think that he will be one of the voices pushing for that, but it will also depend where else the other voices in the administration are. And there is a big propensity among lawmakers, particularly when it's just one political party that has all the branches of government. There's a